Paige, we understand that you're providing your consultancy services via your family trust. In order to prepare your tax return and the tax return of your trust, we need to consider whether the trust has earned any personal services income. Personal services income, or PSI, it occurs when services of an individual, in your case the consultancy work, is provided through an interposed entity rather than by the individual directly performing those services. In your circumstances, your interposed entity is your family trust. Examples of PSI are salary and wages, or income from providing a service without professional assistance. So, example, a doctor or accountant providing a service without any additional support, and income earned from a professional sports person or entertainer. Based on the PSI definition only and on your circumstances, we understand the trust has earned PSI this year, as the consultancy income in the trust is a direct result of your personal skills and efforts. If the PSI rules apply, then the assessable income, so income that is taxable, earned by the trust as a result of your personal skills and effort is to be included in your personal tax return. It cannot be attributable to another family member. If the PSI rules do not apply, your business is considered a personal service business, or a PSB, and there are no changes to the trust tax obligations as it is a PSB. And the impact of the PSI rules is reduced, acting more as a safe harbour. Now, I'll bring your attention to the slides on the screen. These will allow you to follow through the application of the PSI rules and make it easy for you to understand. Now, the first question is as simple as, has there been PSI incurred by the trust? If the answer to this is simply no, then the trust is considered a PSB and the PSI rules do not occur. Now, as previously discussed, your trust has incurred PSI, so we need to then apply the PSI rules and determine whether, via the application of those rules, the trust is a PSB. The first test is the results test. The results test is satisfied in an income year if, in relation to at least 75% of the trust PSI, the income is for producing a result. To pass the results test, the trust is required to produce a specific result, provide the equipment or tools necessary, and fix mistakes at its own costs. Your trust will satisfy the results test if the trust is engaged to provide your services for the purpose of a specific outcome. The services you are performing does not require any plant and equipment and tools, and the trust is required to cover any of your mistakes. Now, the trust will not satisfy the results test if the trust is engaged to provide your services for a specific number of hours per week. You are paid on a regular basis based on an hourly rate, and you are not engaged for a specific outcome. Also, if all plant, equipment and tools necessary to provide the service is provided by the client, so for example, if the client provides you with the software and computer necessary to produce the consultancy work, and also if you are able to actually invoice your client for any mistakes, so your trust is not required to cover those mistakes. If you pass the results test, then your business is a PSB and the PSI rules do not apply. If you do not pass the results test, then the next step is to apply the 80% rule. Now, the 80% rule is based on your client, is concerned with your client base and how much income comes from each client. If 80% or more of the trust income is derived from one client and you believe you'll satisfy the employment test or the business premises test, then you can apply to the Commissioner for a PSB determination. The employment test is where your business employs or contracts others to help complete the work that generates your PSI. The business premises test is where the business premises, used mainly for the personal service work, are used exclusively by the trust and are physically separated from your main residence and any premises of your clients. Another way to seek a determination is if unusual circumstances have occurred. The unusual circumstances require that the circumstances are temporary, so less than 12 months, and out of the ordinary. The trust passed one of the PSB tests in one or more previous income years, and the trust can reasonably expect to pass a PSB test in the following income year. If the Commissioner makes a PSB determination due to satisfaction of one of the previously mentioned tests, then the trust is a PSB and the PSI rules do not apply. If the Commissioner does not make a favourable determination, then the PSI rules will apply. On the other hand, if less than 80% of the trust income is derived from one client, then the following PSB tests need to be satisfied to determine whether the trust is conducting a PSB. The first test is known as the unrelated clients test. This test is satisfied if the PSI is produced from 2 or more clients who are not related or connected to the trust, and the work must be obtained by making offers to the public at large or to a specific sector of the public. The second test is the employment test, and the third and final test is the business premise test, both of which I've previously discussed. If the trust satisfies the unrelated test or the employment test or the business premise test, then it is a PSB and the PSI rules do not apply. If the trust does not satisfy one of those tests, then the PSI rules will apply. To summarise, if the trust is not a PSB, then the PSI rules will apply. Now, the PSI rules, as you can see in this slide, refers to Division 85 and 86. If the PSI rules do apply, then the deductions are limited, and these deductions are rent, mortgage interest rates, or land tax for your home, payments to spouses or other associates for supported work, such as secretarial work, and expenses that you would ordinarily not be able to deduct as an employee. In addition to the limited deductions, any PSI of the trust is to be allocated to the individual, so yourself, who performed the services, and the individual must declare that income in their personal tax return, and it is assessable at their individual marginal rate. On the contrary, if the trust is a PSB, then the PSI rules do not apply. You still need to declare any PSI amounts in your tax return. However, there is no change to the deductions that can be claimed, and the income is not required to be attributed. But a final warning, even if the PSI rules do not apply, if you have entered into an arrangement for the main purpose of obtaining a tax benefit, then the general anti-avoidance provisions will apply. The PSI assessment of the trust must be undertaken every financial year.